Thank you for joining us for our COVID-19 update. Our topic today is the Paycheck Protection Program Flexibility Act. Hi, my name is Eric Trost, and I will be the moderator for today's program. For those of you that are joining us, that have joined us in the past, you may be used to seeing Lee Schwartz as the moderator. Lee is off the grid this week, so I was moved to moderator. We hope you're all hanging in there best you can. We've been doing our best to be a resource for the business community, and today's webinar is another way in which we're trying to communicate the latest and greatest information available. Today's presentation will cover everything we know at this point in time. Please keep in mind that this information is fluid and can change quickly. Our presenters today are Dan Glomsky and Nancy Melberg. They're partners with our firm. We're going to get kicking off with Nancy to tell us a little bit more about the law that passed last week, the Paycheck Protection Program Flexibility Act. Nancy?
Thank you, Eric. So welcome back, everyone who have joined us for our PPP book club in the past. We appreciate you logging in to listen to these additional updates we have. And, you know, I just want to let everyone know that we will continue to put on these webinars as long as we feel there's still relevant information related to the PPP. We are learning things every week, as I'm sure many of you are. And so we will try to continue to keep everyone educated on what we learn and continue to have these as long as they're relevant. So with that, I'm going to get started. And as Eric said, last week, Friday, the president signed the PPP Flexibility Act. So we're going to talk about what that covered, and we're going to go into a little bit more details on what that means for people. So the first thing is the extension of the covered period moved from June 30th to December 31st. So what does that mean? That means if someone got a loan, let's say someone was applying for a loan on May 15th and they didn't receive their funds until May 30th. Previously, the end date was June 30th, so they would not have 8 weeks of payroll in that 8-week covered period because it ended on June 30th. Well, because there's still quite a bit of money left, I believe Eric told us this morning there was still about 150 billion left, so they are still approving loans. So it is possible, if anyone out there has not gotten a PPP yet, there's still funds available, and I would encourage you to apply. And you will still be covered whether you choose an 8-week or a 24-week that we're going to talk about, because that date was now pushed out to December 31st of 2020. Keep in mind, the applications still need to be in by June 30th. So you cannot apply at this point at July 15th. That may change if they still have funds available, but currently it is going to end on June 30th, the exception of applications. So the other thing that changed in this bill was the 8-week covered period. They have now created an extension to that to 24 weeks. It is 24 weeks from the origination date or the date the funds were deposited into your account. Now, keep in mind that anybody out there who received the money prior to June 5th, they can elect to still keep their covered period as 8 weeks. So we now have an 8-week covered period, or we have a 24-week covered period. You cannot elect anything in between. So even if you use all your money in 10 weeks, you are still going to fall into the 24-week covered period. And we're going to talk a little bit more in detail about why that's important as we get into, let's take care of the logistics of the bill first, and then we'll talk about what it means for people. So the other thing is this FTE safe harbor date. So you probably heard us talk about in a lot of other webinars, this June 30th that you still had until June 30th was the date that you could restore your FTEs without seeing an FTE reduction. I want to remind people, or I want to just summarize very quickly what that safe harbor means and whether you can even qualify for a safe harbor. So you have to calculate your FTEs from 2/15/20 to 4/26/20. Then you have to calculate your FTEs on 2/15/20. If your FTEs on 2/15/20 were higher than your FTEs in that first period, then you are allowed to use a safe harbor, and you are allowed to restore your FTEs to which was previously June 30th. They have now extended out to December 31st. So if on December 31st, you have got your FTEs to what they were on 2/15, then you meet the safe harbor requirement and you do not have to take a reduction in your FTEs. So again, just I want to summarize what that safe harbor means and what that calculation is. Now, there's one thing that I want to note here, and I don't have the answer to this, and so I'm going to disclose that right away, is that on the original PPP bill, it says restoring your FTEs not later than. So originally it said not later than June 30th. If you replace December 31st for everywhere it said June 30th, it would read not later than December 31st. However, the actual application reads as of December 31st. So there's a pretty big discrepancy there because not later and as of, obviously, there's a whole lot of time period between those dates. So we're waiting for a little bit more guidance on that, because if somebody qualifies for FTE, they restore their FTEs prior to December 30th, they might not need to wait until December 31st to apply for forgiveness. So I just want to put that out there. We need to get some more clarification on that because yeah, there's been a lot of different interpretation on it, and it's just very interesting how it went from not later than to as of, and I haven't seen any technical changes. So more to come on that, but as of right now, we know that that safe harbor date is December 31st, 2020. So with that, I'm going to let Dan talk about a couple of the other changes in this Flexibility Act.
Thanks, Nancy. One thing I want to say is we'll work through our materials. Once we get through our materials, which we don't expect to take too much longer from that perspective, we do want to open it up to questions. So feel free to put in any questions that you might have in the chat. But let's first go over the content that we have and some of what we consider to be open points or things that we believe that clients should be focused on from a planning perspective. I think you'll hear this a couple times, is that we want individuals, businesses to still make good business decisions and not necessarily be completely motivated by what this PPP forgiveness might mean. But just kind of, keep that in the back of your mind. We'll keep going through that. As we kind of work through now, we have 24 additional weeks to consider in this process. One of the other changes was the Fte reduction exemption. And so the reduction exemption now is more of, if you had an employee that was on your payroll as of February 15th of 2020, and now that employee during the covered period has decided that they don't want to come back and work with you, or and you're not able to replace them with another qualified individual, then you have the potential to exempt that individual from your FTE calculation. And that we believe that the FTE calculation is where things are going to create some problems for individual companies. So that's where I really think we want to shift our focus from the compliance perspective and trying to optimize this. We believe that you'll, as a result of the 24 weeks, be able to come up with a good portion of the expenses needed to use up the proceeds. And then it now comes down to the FTE reduction that could reduce the amount of forgiveness available. So the other criteria that they've inserted is the ability of a business to also exclude employees that they're not able to bring back as a result of, let's say, CDC guidelines that say I can only have 20% capacity, or everybody has to be 6 feet apart, and I can only have 10 people in the building at a time. Whatever the guidelines might be out there for a particular business, that would allow you to potentially exempt some more individuals that you weren't able to bring back as a result of that, basically the guidelines and COVID related consequences of that nature. So that's an important thing, kind of leads into our next one, which is the limitation for forgiveness. So prior to the bill, this current bill, the amount of loan proceeds that needed to be used for payroll costs had to be 75% or greater. Now that number is 60% or greater. I kind of flipped this in the presentation to say that no more than 40% of your loan costs can be allocated to non-payroll type activities for forgiveness purposes. Where this is probably more applicable is individual entities such as restaurants and those that really took a reduction in employees as a result of just not being able to open and operate business, and then may have continued to pay some individuals or had no need to bring them back, but yet they had huge rent, huge utilities to kind of keep things going from a business perspective. So we think that this change benefits those types of individuals, and also might benefit somebody that is going to maybe opt in for the 8 week versus a 24, because now I can take some additional rent and so forth under those types of scenarios. More the real estate or more the restaurants and activities of that nature. But for the most part, we think that this is obviously a positive adjustment, but not one that should impact too many businesses in our opinion, but we'll see the ultimate conclusion on that. Forgiveness request. And so it's under the rules of construction, and the forgiveness application is due now 10 months after the covered period ends. So you have, if your cover period ends June 30th, we have 10 months after June 30th to file that application and request for forgiveness. So that was something that, again, helps us set what time frame we're looking at and gives us some flexibility as far as evaluating whether I want to elect the 8 week period or the 24. But if we were going to elect the 8 weeks, that's 10 months from that 8 week period. So we just want to keep that in mind. There's a couple other changes in the bill that are beneficial to some people, not necessarily everybody. The first one is the extension of the loan deferral. So the lender now has the ability to, so the determination of when you have to start paying interest and principal on the loan portion that is not forgiven is now determined as the forgiveness date. So once it's determined that your loan is forgiven, whatever is remaining after that is now subject to interest and penalty, or interest and principal from that date forward. So that was more of a clarification. Definitionally, it was creating some problems with the old criteria, and based on that the people were still applying for loans, we had the opportunity to maybe have to pay interest and principal before we even knew how much was going to be forgiven. The number 7 here is a benefit that a lot of companies can take advantage of now. There was a limitation for businesses that applied for the PPP loan and got forgiveness, that if you wanted to defer your employer's portion of the Social Security taxes, you would have until the date the loan was forgiven, or to submit your forgiveness application. So between, let's say, March 27th and let's say you made your forgiveness application June 30th, during that period would have been what you were able to defer the Social Security taxes on. Now, the bill has changed that and said it doesn't matter whether you're participating in the PPP loan or not, and whether you've requested forgiveness or not, you're now eligible for this Social Security tax deferral. And then again, the deferral is just the 6.2%, which is the employer's portion of employees' Social Security taxes. And it's from March 27th to December 31st that you can defer that amount of tax. and you defer 50% of it until the 2021, and then the balance of the 50% is 2022. So it's really an interest-free opportunity for a business. Basically, you're creating this, tax liability, which you can now push off. Might free up some cash flow, and there's really no consequences other than the discipline to hang on to that money and understanding that you're going to need to pay it, in December of 21 and 2022. So those are, I think, really things people should look at and hopefully will utilize. But it's now open to everybody, regardless of whether you have the PP loan or not.
And Dan, I don't know if you saw this, but I believe just yesterday, possibly, the second quarter 941 came out, and I believe they revised those forms to include this deferral.
Super. Great. So now we're going to go on to some items that are still open and maybe what is kind of muddying the waters a little bit for us.
So we've now learned that the covered period, we can choose possibly 8 week, or we can extend this out 24 weeks. So I think a lot of people have been asking, why wouldn't I do this? Would there be a disadvantage to extending this out 24 weeks? And so I want to just kind of talk a little bit about that and give you a couple of examples. So first of all, let's say you got a loan for $100,000. And of that $100,000 in that 8-week covered period, you were able to spend $80,000 of that money. Now let's say that you did your FTE calculation and you are seeing a reduction of 10%. So a 10% reduction on the $80,000 is going to be $8,000, and you're going to get a $72,000 forgiveness. Now let's take that same situation, and let's say over the 24-week period, you spent the full $100,000 in the loan, but you saw a 20% reduction in your FTEs. So now you have to reduce that $100,000 by 20%, $20,000. You are now seeing $80,000 being forgiven. So you see an example one, in an 8-week period, you possibly spent less money, but you had less of a reduction, versus taking a 24-week period, you might have spent all the money, but had a higher reduction. So I think what this means for people is we really have to do this analysis to see what situation is better. And I think that the beauty of all this is that you don't have to file for forgiveness until 10 months after your covered period. So you could continue down the path of this 24 weeks. We could do the calculations based on an 8-week period and a 24-week period, and we could see which is more beneficial to the company. And obviously, that's the way you're going to fill out the application. In that same situation, if you were at $100,000, but you spent the full 100, but you had a 30% reduction, that's only a $70,000 forgiveness then. So then you might want to go back to the 8-week, because you're going to see a $72,000 forgiveness. So I think, as Dan alluded to earlier, it really, really depends on this FTE reduction. So here's my concern with this 24-week is that it now means employers could possibly need to keep their FTE count up for 24 weeks. So prior to that, we were looking at maintaining the same level of full-time equivalents for 8 weeks. We now could possibly have to do that for 24 weeks. So I am talking to some companies right now that are just now starting to feel the effects of a slowdown. They didn't immediately feel it, like maybe the restaurants or the salons, but they're starting to feel it now, and they are looking at possibly furloughing or laying some people off right now. Well, if you're just beyond your 8 weeks, then it shouldn't affect you. But if you're going to pick a 24-week period and you start laying people off, if you don't meet the safe harbor reduction, then you have to take the average over the 24 weeks. So I think that's where it's going to get a little bit more difficult for people to maintain that FTE count unless they fall into any of those exemptions that Dan talked about. But again, I think as Dan said too, I think the best bet here is to make good business decisions, continue to operate, possibly don't do things that you wouldn't normally do in the course of your business by paying some outrageous bonuses or adding people on that you don't need, because it is very possible that if this goes out, if you choose to take the 24 weeks, I think it could provide a better benefit for people. But again, I think it's a calculation we're going to have to do on a business by business basis and pick the one that gives you the best benefit of the forgiveness. So Dan, I'll let you talk about this next one.
Sure. So one thing I do want to say though, with respect to this whole process. So my advice would be that just like for a business, we might have a dashboard that tells us, where our receivables are, where cash is, and that type of thing. It might also be, beneficial for us to start to monitor our FTE type of numbers to see how things are trailing along, and whether we are running into any decisions that we need to make. And, the business decision in this whole process is you don't want to, keep and pay somebody an extra $10,000 when you would have maybe had a $2,000 forgiveness hit. So the reality of it is making the right business decision. In order to do that, you really have to know your numbers and kind of monitor where you're going to be at, and kind of maybe project out a little bit. Not to say that everybody should get so totally entrenched in it. It's just, let's get the numbers. Let's kind of see what we're looking at. We also don't necessarily know whether at this point, whether you can make your submission for forgiveness application prior to the 24 weeks expiring. So let's say you're 12 weeks out, you want to make your application for forgiveness. At this point, we don't know whether you have the ability to do that. But that might be something that we continue to monitor. If the application comes out and we have that flexibility, we can go ahead and pull the trigger, knowing the decisions, the information we have in front of us, to make the right decision.
So
another thing, go ahead, Nancy.
That's a good point, but I want to clarify something too that I see I forgot to bring up because I got so excited talking about the FTEs here. So as far as the timing in those 24 weeks, if you do not qualify to use the safe harbor, you have to wait 24 weeks to calculate your FTEs. So to Dan's point, the piece that we're unsure about is, as I mentioned earlier, they talked about that safe harbor saying no later than December 21st or December 31st or as of December 31st. That's the thing we're not sure yet. It's for the safe harbor calculation. But if you don't qualify to use safe harbor, you absolutely have to wait the 24 weeks because you have to calculate your FTEs in that 24-week period. So I just wanted to clarify that for everyone.
Nancy, why don't you hit what the safe harbor dates are again, just to kind of drive that into everybody again?
Yeah. So the safe harbor dates are calculating your FTEs from 2/15/20 to 4/26/20. So that's one period. You're going to calculate them in that time frame. Then you're going to calculate the FTEs in the week that covered 2/15 if you're weekly. So whatever payroll your 2/15 was in, your FTEs on just that date. You're going to compare those two periods, the FTE calc. If your FTEs on 2/15 were greater than your FTEs in that longer 10-week period, then you are allowed to use a safe harbor calculation and say, okay, I am going to restore my FTEs by 12/31. If that's not the case and the longer period had a higher number of FTEs, then you actually have to calculate a potential reduction in your forgiveness. And I say potential because then the calculation you're looking at is your average FTEs in your covered period, either 8 weeks or 24 weeks, divided by your average FTEs in your reference period. So you still have an ability that if in your 8 or 24 week period, you can get your FTEs up to what they were in your look back period, it's possible you could see no or very little reduction. So even though you're not allowed to use the safe harbor, it just means you have to go through now the actual calculation to see what that reduction is, if any. So I hope that clarified that a little bit.
We might have to cover it a couple more times because even when I listen, it's some things that, what periods am I oriented with? So, but we'll continue to try to drill that into everybody. The other element is really kind of an uncertainty for us. And at this point, right, so we go at 24 weeks versus 8 weeks. We knew how the PPP loan was calculating people that were at 100,000 in wages. We knew that they were going to take 8 weeks, and that was 15,385. So we know that for sure, and that's our bottom at this point. We also, but the possibility is really what is, is that number going to change? And by just the principles of looking at 100,000 for 8 weeks versus 24 weeks, the 24-week covered period should give you or yield you a higher maximum level for the $100,000 employees, or maybe even the self-employed individuals. Now, the reality you got to keep in mind, though, is you still received only 2.5 times your weekly weekly payroll. So, or a monthly payroll. But the reality of it is, if you lost employees and, now looking for some additional costs, and it might provide an opportunity. At this point, that information is really not known. So we're speculating, and really even not speculating. We just don't know whether what they're going to do with the self-employed or the greater than $100,000 comped individuals. You will have more time now to pay, your employee costs for 24 weeks. So maybe it doesn't become that relevant, but I do think it becomes very relevant for the self-employed and their ability to use that full 2.5 times before the covered period ends. So we'll see how that goes. But for those that are self-employed, that's something that we'll want to keep monitoring and going forward looking at. The final thing is, one thing that we know for sure is going to happen here is there's going to be more frequently asked questions that the SBA is going to respond to. There's going to be more guidance. There's going to be more, there's going to be a new application. The application that was out there has been recalled by banks and so forth. So that application cannot even be used anymore. So you have to understand that, there's more clarification that's going to come in this. The important thing, again, is knowing your numbers and knowing what this game changer really kind of means. And in my opinion, it means we really need to watch the FTE reductions and make sure we have our good control of that. So with that, we'll open it up to some questions and try to give you some more information or talk a little more strategically about some of these topics.
I did see, Eric, while you're picking a good question, I'm going to answer one that I see came up a couple times. And the question is, if I use the 8-week covered period, can I still use the June 30th for my FTE safe harbor? I don't believe you can. Unfortunately, in the actual Flexibility Act, it says that 12/31 replaces June 30th. The only place it didn't replace it is in the end date when the applications need to be submitted by. So I do think that even though you're using 8-week period, the FTE safe harbor date is still going to be 12/31. I'm actually hoping we see a little bit change on that, and that gets moved back, that people have the ability to choose that if they want. But unfortunately, it looks like that's the way the bill is written right now.
Thank you, Dan. Thank you, Nancy. We'll get started with our questions. Got a number that have come into the chat function. So For folks that want to ask again, you open the chat function and you can ask a question to all panelists, and we'll start going through these. One thing Dan pointed out, just to emphasize, the current application that is out there for forgiveness, that's no longer good because the rules have changed. So that application is, well, you might be able to fill it out as a model to fill out the new application. That application itself is effectively obsolete. So we'll start with our questions. First one comes from Diana. Hello, our business is still way down. If we lay off an employee who is on the PPP application after our 8-week covered period is over, will that negate our opportunity for forgiveness? So Nancy, I'm going to direct that one to you because I really think that gets to what you were explaining between the 8-week covered period or using the longer 24-week covered period, and what happens as you reduce workforce and still use that 24-week covered period.
Absolutely, yes. So if you choose the 8-week covered period and you have maintained your FTEs and then you lay them off after that, it should not have an impact on your forgiveness. So it would only have an impact on your forgiveness if you took the extended period and extended it out 24 weeks. So if you elected 8 weeks, you kept your FTEs the same in those 8 weeks, then you should be good to go. And unfortunately, I shouldn't say good to go, because if you're having to lay people off after that, it sounds like maybe business is down. So we never want to hear that. That's not a good thing. But the good thing is it won't affect your forgiveness.
And Nancy,
Go ahead,
can you talk about, though, I mean, we talk about, you know, a situation of selecting the 8 weeks versus the 24, you know, and we walk through some examples, you know, when we just talk. Can you kind of lay out maybe some things why, although I don't have an employee reduction for the 8 weeks, right, but carrying out 24 might still be a better answer?
Yeah, so in the example that I gave earlier, I think if you have $100,000, but you can't spend it all, if you have zero reduction in it, you're still getting a zero reduction in a less amount that you've spent. So keep in mind that they're never going to forgive you for more than you spent. So if you got a loan for $100,000, but you only spent, we'll say 50 for an extreme, you only spent 50 in that 8-week period, but you have no reduction, you're going to get $50,000. So they're never going to give you the 100 because you didn't spend the 100 on these qualified expenses. So that's a little bit of an extreme example, but if you carried it out 24 weeks, let's say you now used the full $100,000 because you have 16 more weeks that you can use it in. So you've now used the full 100,000, but maybe your FTEs dropped significantly. Even if they dropped 60%, you're still getting, now you have, or let's say they dropped 40%, you have a $40,000 reduction in the 100 that you spend. You're still getting 60 versus the 50 if you would have chose the 8 weeks. So I know this gets very confusing for people, and I know that it's a lot of numbers and we're throwing a lot of calculations out at you. So I think it's just important to understand that we really have to look at both, because you have to see which is going to be more beneficial to you. I hope that answered that, Dan.
Yep, that's exactly what I wanted to say.
Yeah, so I think 2 things to keep in mind. One is you don't have to make the decision right now. You can wait and see how the numbers shake out over time. You can decide to use 8 weeks. 2 months from now, you can say that was better. And then the second thing is, I think you look at what factors would make you think 8 weeks is better than 24 weeks. I think the main factor is if you have a declining FTE count over 24 weeks, you might be better off using the 8-week calculation. If your employment stays the same, if your FTEs stay the same from the 8 weeks through the end of the 24 weeks, you're going to be better off using the 24 weeks as opposed to the 8 weeks. So that's really the driving factor as to when you'd use the 8 versus the 24.
So I want to clarify the FTE because I do see a lot of questions about that. In order to calculate the FTEs, it's the hours worked divided by 40. So there's the simplified method and there's the actual method. So the simplified method is anybody 40 hours or more is considered 1 FTE. Anybody under 40 hours is considered 0.5. So if someone works 39 hours, they're 0.5 because they're not 40. So in that case, you would probably want to use the actual method, which is divide the hours worked by 40. So it's not divided by 30. I know some people maybe only require 30 hours for full time, but the calculation on the application is the total hours divided by 40. And then you're going to average that out for every week in the covered period and the reference period to get that number.
All right, thanks, Nancy. We'll take the second question from Kristen. Will compensation for individuals earning 100,000 plus still be limited to 15,384 with the extension, or will that be increased as well? Dan addressed that on one of his slides that we don't know yet for sure, although the way the law reads, I believe that number is going to increase to 45,000, which is the 24 weeks divided by 52 times 100,000. Almost certainly that guidance will be included in the new application, just as the old application, the obsolete one that's out there right now, listed 15,384 as the max that could be used. I think the new application will give you the maximum compensation that can be used. Next question comes from Jason. We had a federal contract end in May and we are closing the division. How does that impact our FTE calculation? Nancy, do you want to take that one?
Yeah, unfortunately, the decline of business will not be an exception in considering whether you get an exception for the FTEs. So if you're reducing an employees or headcount because you lost some business, if it wasn't COVID related, then unfortunately you're not going to be able to take an exception and you will see a reduction in your FTEs. So that will come into play in your calculations, whether it's in the 8-week or the 24-week. You know, in that case, you may be better off if you then got additional work beyond May. You know, let's say in July or August, you're anticipating more work and you could bring people back on. You might be better off looking at FTEs in 24 weeks because that 1 or 2 weeks isn't as concentrated in the formula as it would be in 8 weeks.
Thanks, Nancy. Next question is related, comes from Jane. In the FTE reduction exemption, if an employee resigned during the period and we did not replace them due to lower levels of business, so less staff was needed, would we qualify for the reduction exemption? And you'd say probably not, right? That's a business reduction, not a COVID related exemption.
Correct. The criteria is you have to basically not hire that person back or try to rehire them back, and then you didn't replace that person with a similar qualifying or the ability to replace somebody with a similar skill or qualification. You know, there's a little bit of latitude there as far as definitionally what does that mean, right? You know, a person with 20 years experience versus somebody that has 2 years of experience. You know, is that the same? But conceptually is that you have to basically somebody quit and you tried to replace them and you couldn't find somebody to replace them is really the requirements for that component. But a business decision of, hey, we're not going to fill that spot, that is not something that's going to help us.
Okay, the next question from owner is, we received the loan on May 11th. The end date is 7/6, assumingly that means the 8-week period ends for them on July 6th. Now you are saying the end date is October 19th. Am I correct? Without looking at a calendar, I don't know for sure when 24 weeks ends after May 11th, but that sounds about right. So can't give you the exact date, but what you do is you start on 5/11 and you count forward 24 weeks. If that's October 19th, that is correct. That's the end of your covered period. So that is the effect of the extension, is the 8 weeks ended 7/6, but the 24 weeks goes all the way to October for you to spend the money.
However, because they didn't get the loan prior to this act, they could still elect to use an 8-week covered period. So they have the ability to choose, I guess, which covered period they want to use.
Yeah, thanks, Nancy. So loans that were received prior to the enactment of what we're talking about today, so prior to last week, you have the ability to say, well, I'm going to use the 24-week period or elect that 8-week period still. Next question comes from Sue. Can you revisit the FTE safe harbor definition and the dates associated with the definition? So we've done this a couple times, but I think we want to do it again because this is by far, I think, the most complicated calculation you have to do in order to come up with your forgiveness and the reduction. Nancy, can you talk about those dates again and the safe harbor?
Yeah. So the dates for the calculation are, you need to look at your FTEs, and this is average weekly. So you're going to take every employee, you are going to take those hours and you're going to put them in every week, and then you're going to average them out to determine the average over the course of that period, 215 to 426. And then you're going to just add all those up. So whatever the calculation is. Now, remember, you can use the simplified method. So if those people end up an average over that period of time of 39 hours, they're going to be considered a 0.5 FTE for that one individual. Then you're going to add all those up and you're going to get that number of FTEs. Then you're going to do the same calculation, but just for the payroll that included 215.20. If that particular number of FTEs, once you add them all up, is greater than the number of FTEs in that first period, that longer period, which is, I think, about 10 weeks, if that's the case, so let's say you had 4 FTEs on 215, but you had 3.7 on 215 to 426, you now qualify to use the safe harbor. In other words, you can now look at your FTEs on 12/31, and if that number is greater than or equal to 4, you're good to go. You have no reduction. If that number is less than on 12/31 than what it was on 215, you now have to do the calculation to determine the reduction in your FTEs. And that is a completely separate calculation. And that's where I think this gets very confusing for people. So that calculation is your total average number of FTEs in your covered period, either 8 weeks or 24. And this is why it's important, you know, that we may have to go out 24 weeks, because it's that number divided by, I keep saying look back period. I think in the actual application, they call it the reference period. And that was the period that people got to choose of either 2/15/19 to 6/30/2019, or they could choose 1/1/20 to 2/29/20. So they're looking at that number. That's the denominator. So you have to divide your covered period by your FTEs in that period, and whatever that percentage is that they were reduced is what you have to reduce your forgiveness by.
Thanks, Nancy. I think sometimes it might, yeah, that was a lot. What sometimes helps is to understand maybe what they're trying to accomplish with this calculation. If you think about the what they want to accomplish with this calculation, I think they're looking at 215 and they're looking for a reduction that occurs in the next 10 weeks. And then you restore that reduction. So it's almost as if they're saying as of 215, that's a pre-crisis or pandemic date. And then the measurement period from 215 to 426 is during the heart of the pandemic. And I think what they're saying is if you have a reduction because it was caused by that pandemic, we'll assume that 215 to 426 measures that. And then your restoration is back up to pre-pandemic, pre-215 or 215 payroll. So they're looking for you to go backwards because of the pandemic, and then you can use the safe harbor. If you don't go backwards from 215 to 426, the assumption is you did not, weren't affected from a payroll standpoint or an FTE standpoint from the heart of the pandemic, and therefore you cannot use the safe harbor. I believe that's the purpose of it. So understanding that maybe helps you understand why they're picking these random dates that seemingly to do these calculations.
Yeah, absolutely. Thank you, Eric, for clarifying that. And I've gotten people ask a lot, why 426? And it's 30 days after the PPP was signed in. So the PPP became a bill on 326. And so they took 30 days after that, because people obviously in that time period weren't applying for a PPP because it didn't exist until 326. So they really weren't applying until after 326 till we saw the application. And that's possibly when they maybe just started bringing people back. So I think, Eric, that was a great summary, that if you weren't affected from 215 to 426, then probably COVID had nothing to do with the reduction that you may have had after that.
And I think one thing that I want to make, I see a couple questions out here that, is there a level of reduction that's allowed in FTE before the forgiveness gets impacted? And the answer to that is no. I mean, as soon as you have, one reduction that results in a percentage decrease, that percentage decrease is what is going to result in some of your PPP loan not being forgiven. So to us, it's a golden number that we want to try to, leverage everything we can to make sure that we don't have a reduction, so that we can get to the potential 100%.
There is, however, and I guess I failed to bring this up earlier, there is, however, in addition to the FTE reduction, there's a wage reduction. We haven't seen this really I haven't seen it from anyone that I've talked to, but I guess it's a possibility that it's out there, that if you kept an employee on for 40 hours a week, so you're keeping your FTE where it needs to be, however, you reduce their wage 30%, then you could take a potential reduction on a wage reduction. You are allowed 25% without taking any hit. But if anybody's actual average hourly or annual salary is reduced more than 25%, that could be an additional reduction in the forgiveness. So there's really two. There's an FTE and there's a wage reduction. The wage reduction has a 25%, you're allowed. FTE has nothing. And again, I really haven't come across a lot of people that have dropped hourly wages or salaries for people. It's been more furloughing people. So the FTE seems to be the one that's most concerning. Nevertheless, I think people should be aware that there's also this wage reduction out there in case that, affects your business at all.
All right, thanks, Nancy. Thanks, Dan. Next question from Megan. When do we have to make the determination if we're going to use the 8-week or the 24-week covered period? Again, you don't have to make that choice until you can look in the rearview mirror and see what's best for you. If you do use the 8-week covered period, know that you have 10 months to file the application from that date for the forgiveness. So got a long time to essentially look at everything as it happened and then decide what's the best for you. So you don't have to make that decision right now. Next question.
Just before you expand on that, one comment I wanted to make on making the application for forgiveness. Remember, the loan, if you have a portion of the loan that's not forgiven and you're going to take the loan, the 1% interest loan, that won't start until that date of forgiveness is determined. So the longer you push out that forgiveness application, the more deferral you're getting on having to make a principal and interest payment on that unforgiven amount. So there's another benefit. So even if you pick the 8 weeks versus the 10 weeks, you're going to also look at whether you're going to, if you have some loan that you're going to take on, how far do I want to push that out? Now, if I'm going to take and and just repay the money and I don't have an issue from that perspective, then the timing of the application is not necessarily as critical. But that's one variable that you also want to consider as far as, when I file that forgiveness application. One is, let's figure out the certainty. Let's figure out whether 8 or 24 is good. And then maybe I have that figured out, but now I want to defer my loan. Well, now I want to push that out. So I make my forgiveness application, further along in the process.
All right, thanks, Dan, for that clarification. Kim asked, what's the look back period versus the covered period? So Nancy, do you want to explain the difference between the look back period and the covered period?
Yeah, so the look back period, which is also called the reference period in the application, that's the period that you choose to be your denominator in your calculation of your reduction. So if it is 2/15/19 to 6/30/19, it could be that, or it could be 1/1/20 to 2/29/20. So you're picking one of those periods and you're basically comparing your covered period, which is either the 8 weeks or the 24 weeks. So you're picking one of those periods, you're dividing your FTEs in your covered period by your FTEs in that look back period to determine if there's a percentage reduction. So this is where I think even if you fail the safe harbor calculation, I don't think it's game over yet, because I think if in 24 weeks you can get FTEs as close as they were to the period that you chose as your look back or reference period, you could still see a very minimal reduction. I happened to do a calculation on one the other day and it was like 2%. So it was very minimal. But that's what those two periods are used for.
All right, thanks, Nancy. So the look back period is the one of two periods, 1/1/20 through 2/29/20, or 2/15/19 to 6/30/19. Those are your choices for the look back period. Your covered period is variable. It's the day that starts when you get your loan and it ends either 8 weeks later or 24 weeks later. Next question from Vicky. If you choose to use the 8-week covered period, can you still use a 6/30 safe harbor date? No, actually, we already answered that one. I shouldn't even read it, but that's if you choose to use the 8-week covered period, you still are stuck with the 12/31 safe harbor date. Next question from Aaron. Can you clarify, since 2/15/19 is a Friday and the end of a week, do we do the FTE for that week or start on 2/15/19? So going forward. So Nancy, do you want to talk about what these days mean as far as falling within a payroll?
Yeah, so again, there really hasn't been a lot of clarification on how we pick if something is in the middle of a week. Is it hours incurred? We haven't seen clarification on that yet. And I know that we had a little bit of discussion internally yesterday as to whether you use the hours that were incurred but possibly paid on a different date. I think for 2/15, what you have to do is you have to use whatever payroll included the 2/15 date. And so if 2/15 was included in a payroll that you had on 2/20, an actual payroll that was the check date, I would use that because it included that date, because I think it's going to be very difficult for people to be trying to calculate this number based on one day in a pay period. And I think the thought process was, around 2/15, that's a date we're looking at. Again, if you look at the whole concept of what they're trying to determine here, I think it's a payroll that includes a 2/15 date.
Thanks, Nancy.
And we may see clarification on the application. When the final application comes out, it's possible we could see clarification on that.
Next question comes from Erica, who says, can you send us an email with the safe harbor calculation dates and means of calculation in written form? It is too much to absorb when delivered in spoken form. Hey, I'm right there with you.
Yeah, you know, one thing I would say to people, because this is how I really wrapped my head around it and worked with putting all this together and understood it, was to look at the application that's out there. I know that that application is old now and it will be replaced with another application. But if you really follow the steps on that application, they lay them out beautifully. I mean, they literally tell you step 1 is this, step 2 is this. They tell you what you need to calculate. So I would say look at the application and just take a pencil, and you can even start penciling in some things there. And I think that might help people to understand a little bit better these numbers and what you're looking at and comparing to. I think somebody just said it's page 9 of the application. I think we just saw that pop up. I think it's at the bottom. I can tell you.
Now remember, this application, while it can be used as a model and an idea of what's going to happen going forward for the next application, the current application is obsolete, so you will have to fill in a different application than the one that's out right now.
Yeah, but to understand it, it is the bottom of page 9. So thank you, whoever typed that in the chat. It's the last half of page 9 on the application. And it's actually under the worksheet A.
All right, we have time for one more question. Can we still take more than 8 weeks of pay during the 8-week period based on paid and incurred? Or is that possibility removed with the extension to 24 weeks? Nancy,
Dan, I'll let Dan take that one.
Okay.
So, Eric, can you restate the question? I want to make sure I answer the right one here.
Yeah. So what this person's looking to do is, did this Paycheck Protection Program Flexibility Act, did they change anything with respect to taking the 8-week period and using paid and incurred? Or, now that they have the 24 weeks, is that gone?
Yeah. So the answer is that has not changed. So that our understanding is that well, the bill didn't specifically change any of those things. And to be honest, those additions were more additions through the application process and not as a part of the actual statutory bill. The reality of it is, with 24 weeks, assuming you use the 24 weeks, you should not run into any problem being able to use up the cash that the loan provided, because the loan was 2.5 times your annual, your compensation, monthly compensation based on, let's say, 2019's data. And I understand there might be some things and so forth. So maybe it takes it out 12 or 13 weeks, but really we've doubled the time period that we're allowed to take expenses. So we don't see it really creating a problem for businesses to be able to use up all the loan proceeds for qualifying expenses. And when we get to the actual application, the definition of those things we expect to be the same, but the government surprised us a couple times, and we will probably have to roll with that. So I wouldn't get too hung up on that. Right now I would include it, kind of do your calculation similarly as you have in the past, and now just extend out the weeks, and really kind of switch your focus maybe a little bit to the FTEs. Is that answered, Eric?
Yeah, thank you, Dan. I guess we've got to about 10% of the questions today, so I got a nice tidy 90% that unfortunately we're not going to be able to get to today. Do appreciate everyone for coming on. We have recorded this session. There you go. You can go to sbaaccountants.com /COVID. Is that /COVID, it looks like. And you can get a recording of this session that will be available probably within 24 hours. And then if you've got questions and you are a SBA client, please reach out to your accountant that normally services your account. We are also open if you don't think you're getting these answers from your current advisors. please contact us. You can contact Lee Schwartz. His name and number are there, and he'll get you set up with someone that can help you out. Again, thanks everybody for joining us, and we do expect when the new application comes out and more guidance is issued, we'll be having another webinar. So look forward to us again in maybe a couple weeks. We hope you'll join us then.
And I do want to just say real quick before we log off, we do try to keep up with e-alerts. So as soon as we know that there's information out there that's pertinent to everyone and we want to get it out quickly before we do another webinar, we will send out an e-alert. I believe if you go to that SVA COVID website, you can sign up for e-alerts. So I would highly recommend everybody to go out there and sign up to get the e-alerts, and we'll push information out as soon as we have any changes or have any clarification on anything.
All right, thank you for all attending.
Thank you.
Dan, say thank you.
Thank you.
All right, bye.